Karthik Kumar is fund manager at Axis Mutual Fund, is with us to sort of take some questions. Karthik, great to have you with us here. Thanks for your time. The big debate, of course, is how does one sort of navigate the start of the easing cycle and the easing cycle itself, because it's going to be Fed and then maybe others will follow. And not exactly synchronized, but that's the general expectation into the end of the year. Some, depending on who you ask, between 75 to 125 basis points worth of rate cuts. So at Axis and you and your team, how are you sort of viewing this and implications for markets here in India?
I think with rate cuts, obviously, we're already seeing sector rotation on a much more frequent basis than we did see before. Part of it, I guess, we could attribute it to uncertainty coming from macroeconomic policies in the West. But at the end of the day, we are, as a house, we are much more focused on ideas and on looking at themes here that are much more specific and positioned accordingly. But what you're seeing in the markets is essentially over the last couple of months is it's been consistent in the sense that the breadth of the market, or rather the spread, like the case today, where the outperformance of mid cap and small cap to large caps have narrowed compared to what it was the case, what was the case previously, and also sector leaderships and from strictly speaking from a quantitative framework, style leaderships have also evolved over the last 3 months. So we are positioned accordingly to that, and more from a bottom-up perspective and less so from a top-down angle.
Okay. Yeah, so sector rotation and some change in leadership, that's we're beginning to see some signs of that, Karthik. Good to have you on the show, by the way. Good morning. So to be here. So, the basic question that came to mind yesterday after looking at the Bajaj Housing Finance listing is, is the market still willing to pay top dollar and digest those kind of levels for stocks where there could be promise? What is your sense? I mean, for a housing finance franchise, would you be willing to pay, 6 times, 7 times? Are we back in that zone?
It seems like, based on what the data we've anecdotally seen, we are back in that zone. But essentially, if you look at what's been working over the last 2 or 3 months, as you rightly pointed out, we are seeing sector rotation. And the other thing we are seeing is a switch back to quality, where the market's focusing back on some of these low beta names as a theme, or even looking back at stocks and sectors where your ROEs are structurally much better. And so the focus has come back to a bit more quality over the last 2 to 3 months, whereas your styles that were leading previously, which was growth and valuations, have kind of taken a backseat for now. And that is evident even when you look at it from a sector perspective, where be it FMCG or pharma or IT, those sectors have kind of done well over the last 3-4 months, whereas the leaders from the prior 3 months or 6 months have kind of taken a halt here.
Well, you spoke about quality, and we are seeing a bunch of stocks doing well, as the hotboard on the screen also suggests. The only sector which is seeing the most amount of gains right now is FMCG. Was under pressure in yesterday's trading session, routine profit taking, one may say. I just wanted your thoughts on this quality versus all the others battle itself in the market right now. Because while quality did not see a multiple re-rating, it was already at premium valuations. The others started to rally, and as a result of which that valuation differential got narrowed. To that extent, does it make quality attractive largely from a valuation standpoint, or more is it more of capital protection that you're looking at, given the sort of up move that we've seen in a lot of places?
I mean, you're absolutely spot on in the sense that quality was expensive a couple of years ago. Just to put this in context, quality has had a rough ride for almost year and a half now. So to that extent, the other styles or the other areas of the market have caught up in terms of valuation. And quality, given its nature, will always trade at, I would argue, would always trade at a premium to general markets. So the larger theme in the market has also been catch up, whether be it at a stock level, sector level, or at a style level. So you could attribute it to focus on capital, or you could attribute it to general nature of the markets to focus on areas of the market that have kind of lagged the headline numbers, and so which is where the focus has come back to quality. And the fact that the valuation spreads have narrowed has kind of helps reinforce that case. But as I said, the quality as a basket would always trade at a premium to markets, in my opinion. That is unlikely to change.
So what are your top sector picks right now?
Right now, I'm bullish consumer staples. I'm overweight healthcare and discretionary. Whereas I continue to remain underweight energy, commodity plays, and IT.
All right. Karthik, on IT, would the view change a little bit at the margin at all because of the rate cycle? You know, most IT companies, when we speak to them post results, not actually most, but many, and I'm talking about larger ones, they do flag off this higher rates in the US as a bit of a problem. To be able to tap into new business and how, so I'm assuming that if the rates start to come off, I mean, business should at least the margin incrementally pick up. Wouldn't that reflect for you as an investor as well?
So on the margins, I've kind of reduced my underweight positioning in IT. But having said that, if you look at the earnings profile or the expected growth rate over the last 2 years, or over the next 2 years, I mean, the fact that we are going to be in an interest rate cut cycle is a certainty. It's just the timing and the pace at which we are going to go through it remains is debated. But the event itself is kind of all but confirmed, right? So to that extent, despite that, what we are not seeing is a broad-based improvement in earnings indicators so far across IT. Selectively, you do see it in stocks, but not across sectors in a broad-based way. Which is why, while I've reduced my on the margins, I've reduced my underweight to IT, but that is more coming from stock-specific picks rather than a sector-based call.
In terms of just market, again, this is because rates are starting to come off. What does it mean for smaller businesses? Do smaller rates mean at the margin are much more positive for smaller businesses to be able to access funds? And I mean, it means a lot more, right? Larger entities can access funds anywhere. So for the small and mid-cap universe, as we go into the next, say, 6 months, 8 months, what does this mean?
I think it also depends on under what economic context are we talking about in terms of the rates coming down. If it's a soft landing, then it could mean all that you said for all things positive for mid caps and small caps. But if we get into a kind of an if we have economic headwinds and the interest rate cuts are happening in that scenario, then one could argue, at least from a portfolio positioning and from a stock positioning, probably large caps would be a better place to look at rather than mid caps and small caps. So instead of looking at just, I would prefer, instead of looking at just interest rates in a silo, we also look at in what context are we talking about, and are we talking about a soft landing, or are we talking about something slightly more negative than that?
All right, take your point. Thank you so much for stopping by and giving us your sectoral calls, your view on the market on the whole. Positive on consumer staples, prefer large caps over mid caps and small caps. We keep an eye out on that. In fact, the next discussion that we've lined up would be a theme of your interest itself. It's got to do with the consumer staples, and all of them actually doing well. We have Britannia, HUL, Tata Consumer among the top Nifty gainers right now.